So let's get serious, Ricardo. We talked about a lot of deals, but let's talk about returns. Tell me about it.
Okay, so sometimes when people come to me and they say, oh, you should buy this because it's going to be a home run. I said, okay, well, is it going to be a home run at the Astrodome, or is it going to be a home run at my little kid's Little League ballpark? Because I can hit one there, but I can't hit one over there. So when they use subjective terms like that, I'm not really comfortable with that. Returns is something that we've always focused on this, is what do you put in your pocket at the end of the day? If someone comes to me and says, look, we're looking for yield, what can you offer us? An accredited investor, of course.
Right.
Say, we're looking for yield, what are you talking about? I said, what are you looking for? Because if they say, well, I'm looking for 2 or 3, 4%, we tell them we're not your product. Because we cannot compete with treasuries, we cannot compete with municipal bonds, we can't compete with that type of an investment product, and that's what you're going to get. If you're looking for a 2 or 3% yield, go to treasuries. You're looking for 4 or 5%, lend it to the city of Austin and let them pay you a 5% on their municipal bond. Once you start getting into the 6+%, that's when you really start talking about commercial real estate or investment real estate, because it could be multifamily. So that's about where you are. So in that range, then you start talking about very stabilized income producing assets in the 6, 7, 8% range typically. That's about right. And I'm speaking now from a development standpoint, from a development company standpoint, not a yield to a passive investor.
Right.
That we're speaking of more of a broad spectrum real estate investment return to a project, not to an investor necessarily. So when you talk about you want a little bit more, you're looking at 8 to 10%. You're looking at an income producing asset that may have a vacant space, or an apartment complex that's got a little bit of work that needs to be done, or it's a little bit under occupied. That means that there's some vacancy there. There's a space that's vacant, or there's some apartments that are vacant. You're going to have to work a little bit to get those tenants in, get them in, get the income up, and then that gets you a better return. Then after that, you really start getting into the development aspect of it, where the project at the minimum has to start yielding 12 to 14, 15%. And that's for where it's a very quick deal, where it could be a standalone type of product, where someone like the Olive Garden, if it was just a one pad, comes to you and says, we want to be here, what is it going to take? That's about that investment. And then really the true development aspect. We won't look at something unless it's at least 20, 22% to the project. And realistically, we're closer to 30%.
Yeah.
Because you've got to pay the investors, you've got to be able to pay your staff, your team, the time that it took to get that product to market. So sometimes when I see some other firms that are offering 16, 18% yield just to the investment group or to the passive investor, and you're talking about a product that's maybe yielding 18 to 20%, it's just pure math. At that point, you're saying, look, it's only going to cost me and my profit about 4%, the 16 on top of the 20. How do you make that work? So that's why we will primarily look at deals that are 30+%. And we see that on a regular basis. If it doesn't pencil that, we probably wouldn't even look at it. And that's why we like the Rio Grande Valley, because there's a tremendous of opportunity to where you can look at a bunch of deals and cherry pick what you like out of that. And we're involved in some deals now that are well above 50% yield, cash on cash, internal rate of return on an annualized basis. Because you need to be clear about that. Some people say, well, I doubled my money as an investment. I doubled my money. Yeah, it only took me 7 years. That's not accurate.
Yeah.
Right? That's not accurate. You didn't double your money. Doubling your money means year on year. If you invested $100 at the end of the year, or the following year you have $200, that's doubling your money. If you took $100 and then in 7 years you have $200, that rate of return is only about 10%.
Right.
Right. So the rule of 72, so to speak. But so that's about where we as a firm really focus on. 30 plus to the project. That way we're able to pay our investors a comfortable rate. We can pay ourselves, we know our expenses are covered, and we also create a profit, which is why we're in business.
Mm-hmm. And both the retail deal and the multifamily deal that we discussed this morning kind of meets that criteria at a minimum.
Yeah, the one we saw today was over 30, and we're comfortable with that. We'll if they accept our offer, we'll pull the trigger on that, take that down, and move forward. And one of the things about real estate and what we do, folks come to see me. We've been in this business now for 21 years, and it's always fun to work on something. People come and go, and then they come back a few years later. They're like, "Oh yeah, that's what you were talking about." So it's fun to just I call it left foot, right foot. Just keep churning through, keep pushing, If you believe in the idea, follow it, focus on it, and stay with it through fruition. And that's what's been key for us for 21 years.